Ag Country offers a wide range of internal growth. If you have a goal in mind and you put your mind to it, your successes can be endless.
There are so many jobs within this company that you can rotate into.
I like challenges. Ag Country gives me challenges.
Yeah, Ag Country is a great place to work. There's plenty of flexibility. You're never tied to your desk. There's a team here that is always there for you.
Yeah, grab your role and run with it. And always be aware of the opportunities because they're in front of you.
Hi, I want to thank everyone for coming here today. Today I have, or we'll be talking about margin protection and our tool Optimum that we use to analyze crop insurance. With me today I have Blake Smith. He works out of the Fargo and Detroit Lakes offices. And also we have Joel Lisney here. Joel will be speaking about margin protection, and Blake will be speaking a little bit about the tool Optimum. And I'll just be kind of doing a brief introduction, and hopefully I last longer than Aaron Rodgers did on Monday night. So first off, I just want to talk about the area that Ag Country Farm Credit services. We have a wide territory all the way up from Williston to Crosby over to Roseau. Down to Redwood Falls and also in central Wisconsin. Today, based on the geographic region, we'll be kind of focused on the southern Red River Valley. But if you guys have any questions wherever you guys are from, I would reach out to one of the number of specialists and in these offices listed here, and they'll be more than happy to provide you with answers with your region. Also, Ag Country does more than just crop insurance. We also provide loans, succession, retirement, tax and farm accounting. So if you guys have any questions about that, reach out to any one of the offices or myself or anyone here, and we'll lead you in the right direction. So I'm just going to talk briefly about margin protection here, and then Joel's going to go in more detail here in just a little bit. So margin protection, it's just it's area-based coverage. Providing additional protection against unexpected decline in operating margin. The first thing to consider would be the cost of some of the inputs, which I'll touch briefly about here in just a little bit. And also, just for you guys to know, we can buy margin protection for corn, soybeans, and wheat in Minnesota and North Dakota, and also South Dakota is included because there might be some people from South Dakota here today. So part of the formula, they use variable cost, and they track that based on the Chicago Board of Trade discovery price. So I just put this here. These prices were as of last week. The discovery period actually ends, I believe, tonight or tomorrow. Yep. But this is just what last year's discovery price is compared to this year's. As you can see, DAP is down, and also potash is also down significantly. Josh Linville had a great presentation yesterday with StoneX about some of the fertilizer prices. So I would urge you guys to watch that. There's some great insight on some of those those commodities. And also, like everyone knows, interest rates up and diesel is up a lot as well. And then also, before Joel speaks, I want everyone to kind of have a little bit of a reference point to some of the yields that we're talking about here. So these are, for Cass County, these are the expected yields for corn, soybeans, and wheat. These are the county averages. This is what's going to be used for the formula. And then you take the expected revenue, which again, these prices were as of last week. They'll be set either tonight or tomorrow. And then this expected margin, that's the amount that we're looking to protect here today. So I have Cass County yields here, and then I also put up Clay County as well here, just for reference points, so you guys can compare to your farms. But yeah, I will hand it off here to Joel now, and
Perfect.
He'll talk more into depth about it.
Thanks, Jacob. You guys hear me okay, by the way? Okay. Just real quick, I think we sent out a mass mailer on margin protection to a very large part of our territory, just because of the uncertainty in the global markets right now, and what we've seen in the downturn trends on some of our commodities, especially wheat and corn right now. margins are getting pinched a lot tighter than they were previous. And I think this is where margin protection can possibly have some protection, risk protection for our producers. So we're going to talk a little bit about this. It's pretty involved, but I'll make it feel better at the end here, okay? So what we're going to talk about first, we're going to get into a little bit of history about margin protection, and it's fairly new. I mean, it came out back in 2016 and introduced it just to our wheat producers. Just kind of put a little feeler out there. Is this going to be something that might have some traction? Well, 2 years later, RMA released it, introduced it for our corn and soybean producers also. So we've seen some traction with it. It had a little bit of a slow beginning to it, but it is an area-based protection plan. So unlike your multi-peril, which is specific to your operation, this takes more into consideration like county input costs, county yields, prices that are established by RMA, so things of that nature. Next slide, if you could, Jacob. All right. So the options, okay, margin protection. You can purchase this. Again, you'll hear me say this a number of times as we're going through the presentation, but it is area-based coverage, okay? Don't lose sight of the fact of that, because your multi-peril policy obviously is specific to your operation. This is something that you could actually use to stack on top of your multi-peril policy, or you might just decide, you know what, I correlate with the county pretty well. I might just use this as my only option for insurance, okay? As you'll see on the slides here, you can choose a coverage level from 70 to 95%, which is kind of unique to this particular product because, as you know, on your multi-peril policy, you can only go up to 85. So again, it's a way to kind of a little bit more risk protection for you. Very particular to this and very similar to like products like ECO and SEO, your protection factors, you can actually buy up on your indemnities, okay? So if you decide you want to save some premium, you can buy a protection factor at 80%, which means you're only going to get 80% of that indemnity if you trigger a claim, okay? The flip side of that, if you want to pay some extra premium dollars, you can increase that to 120%. So instead of getting paid at 100% of your claim, you could potentially max out and get up to 120% of your claim for margin protection. So because this is an RMA approved product, our producers can get a discount like very similar to their multi-peril. The more risk you take on, very similar to how the multi-peril product works, the more risk you take on, the more subsidy you're going to get, the more of a discount off your premium. Obviously, like you say, you see 70% coverage level, 59% subsidy. You go up to 90%, they're only cutting, they're still paying almost 50% of the bill. So anytime you can get 50% off, or 44% in this case, not a bad day, okay? So let's talk about what this margin thing is, okay? How your revenue policy works. Take a step back. What goes into consideration is everything that you do on your farm, what your yields are, what your APHs are, what the price is right now, okay? And what level you select at sales closing back in mid-March, okay? Those will determine your coverages. That's how your multi-peril policy works at this stage. Now, margin there's some different components to this particular product, okay? There's county yields that go into play. There's market prices that go into play. There's variable inputs like your P&K, diesel, interest rates, those kind of things go into play with this particular product. And those are the things that can trigger, or a combination of all three can trigger a claim for you, okay? So, like Jacob had mentioned earlier in his presentation, or part of the presentation, he talked about what are the inputs that go into this. Well, You'll notice there's a number of things. Your county yield goes into play, the discovery price, which we're talking about. Today is the last day that'll be established, what they call your established price for margin protection, is getting set after today. So instead of waiting until the February averages for your multi-peril that get released on March 1st, these inputs are actually, these inputs and prices are actually set September 15th, okay? So these prices are getting set 5.5 months earlier than your multi-peril prices are getting set, okay? These are gonna be taken into consideration from this time going forward for the 24 crop year, okay? So even though we're in 23, we're actually setting the price right now on inputs and on prices for the 24 season, okay? Let's see, what else can I tell you on that? P&K, diesel, interest rates, and then on that final one on the bottom, it says fixed costs. That's kind of that's an RMA determined number, so that'll be specific to each county. So that'll be something that gets set early on here, but there's no harvest price that goes into effect for that. That's just gonna get set at this time, okay? So what we've done is we've set the bar, okay? This one is gonna take a little bit of time to go through, but I'm gonna reassure you at the very end that it's nothing you really need to be too concerned about, okay? So, like we're talking about with these expected prices and yields, the yields were actually set for your counties like in early August, okay? Your expected prices and your expected costs will be set tomorrow. September 15th is the day that those days get set. So what that does is that you come up with what they call your expected margin, okay? Now, again, you have to sign up for this particular area-based plan of insurance by September 30th, okay? And you're gonna select, again, the price or the protection factor, and you're gonna select your coverage. So you'll see on there it says your expected margin minus deductible. Well, that's gonna be what kind of protection you take, or coverage you take. So, and that will be what they call your trigger margin, okay? So we're gonna hold on to that trigger margin for a little bit here because we're still in 23, but this again is for the 24 crop year, okay? So if you slide over to the next slide in the middle there, then we're gonna take a look at harvest price times the yield, okay? Well, the harvest price is gonna be set at the same time your multi-peril harvest price is set in 2024, okay? The dates, you gotta really kind of be cognizant of the dates here because this is a long journey here. This isn't just like your normal multi-peril policy is just you select your coverages, you go through the year, you'll find out if you have a claim. This, you're kind of getting ahead of the game here. You're playing the game, and then we wait for all the information to come in at the very end, and that'll determine if you're in a loss, okay? Because again, it's area-based coverage. So we have to wait for the county to get their information in, and for the prices to get set, all that kind of stuff, okay? Your harvest costs, now this is unique to this particular plan of insurance. Your harvest costs are determined when you're planting, okay? You would think, okay, that's gonna get set later in the year. It actually is taking into consideration those costs as you're planting your crop. So those inputs that are getting planted, it's real time. So those get determined and are established in May 1st. The thing that really drags this along a little bit, again, is the fact that you have to wait until that production is actually reported for that crop year, which follows into the next year, which again is the production reporting deadline is April 29th. So RMA waits until all those yields have been, sent in. They'll pull the SIMS data for that and see that they'll set those yields, I think, in early May. And then if we have any sort of claim or anything like that, that will trigger that in June. So you're gonna set your harvest margin, and then it's gonna bring it down here. So you got your trigger margin minus your harvest margin, okay, equals a loss. Seems pretty involved here, okay, guys? Again, just hang with me for a little bit here. That production factor that you can choose, 80% to 120%, that'll determine if you're in a loss, how much of that indemnity you're gonna get paid. Am I gonna get paid 80%? Am I gonna get paid 100? Am I gonna get paid 120%? So if you stack this on top of your multi-peril policy, thing you gotta remember with this type of insurance, I want you to make sure when you go into something like this, because it's got some teeth on the premium, you gotta go into it knowing if I've got a multi-peril policy already in place and I stack this on top of it, RMA won't let you double dip. Okay, so if you have a multi-peril policy and you have a margin claim at the same time, those two claims go on top of each other, they won't let you take both of them, so they'll subtract the multi-peril claim away from the margin claim. So if that makes sense, it's a double dipping thing is how you look at it. But that's kind of how a claim works, okay? A lot of talk on it. The thing that I want to assure you, you don't have to keep track of any of this. This is all RMA that sets these prices, that follows these prices, and they will be the ones to determine if you're in a claim or not, okay? So just to kind of set the bar for us, when I looked at expected prices for this year, okay, we're gonna set we're going back to what the expected prices for September are gonna be. 509 on corn, okay? Just to give you set this on your multi-peril, your discovery price on multi-peril was 591. It's dropped to 509 at this point, okay? Soybeans were 1295. Your multi-peril price was set at 1387. 805 on wheat, 887 on wheat. That just fell to the harvest price just came back on that, and that was 797. So this just kind of gives you a little bit of a head start on where prices are going and what you can kind of protect for that, okay? Dates, okay? Like we talked about before, we will be ending the base price establishment for inputs and for commodity prices. Today is the last day. Those will get set tomorrow. If you choose that you want to sign up for this plan of insurance, you do have to do it by the end of this month. September 30th is the sales close date, whereas if you have a regular multi-peril policy, you're used to having that done in March. Some of you guys, this is something really important because I think we're starting to see more traction on ECO and SCO, okay? If you decide you want to sign up for margin protection, this plan of insurance, you cannot have ECO and SCO at the same time, okay? That's a area plan of insurance also. RMA says you got to take one or the other. You got it, or one of the three, ECO, SCO, or margin protection. If you sign up for margin protection, you do have to cancel out of your ECO or SCO at sales closing, okay? Really important thing to kind of keep in mind for that. We're gonna go through the spring, we're gonna plant. We're gonna get to April. Those harvest inputs, again, like I mentioned before, they do the discovery on that through the month of April. That gets set May 1st. And then we're gonna go through the season. We're gonna do all our spraying. We're gonna do all that. We're gonna get to harvest. We're gonna harvest that crop. But then in October, there's a lot of stuff going on because we're gonna start getting into discovery on corn and soybeans to set that harvest price like we would our regular multi-peril policy, okay? But the thing you gotta remember with this particular product, when you sign up for it, your multi-peril, if you decide to stack margin protection on top of it, those premiums are all due at the same time, okay? This doesn't drag into 25. Your multi-peril premiums and your margin protection premiums are all due October 1st. Okay, so you're paying a little bit of hurry in advance, not knowing if you're going to get a payout on your margin protection. Your multi-peril policy is, you know how that works. If you got a claim, it's going to get paid this year, most likely. Okay. After the harvest, like I had mentioned before, what really drags this thing along is just waiting for all the yields to get updated with your county agents, okay? So that's why we don't know if you're going to be in a claim on this until after the end of April, after the production reporting deadline, okay? Once that gets determined, those numbers are released, you're going to find out if you are in a claim, and those claims usually get paid out in June, okay? And, okay, like I had mentioned before, the thing that is attractive about this, I think, is it gives you 5.5 months. You're going to know what your discovery, what your expected margin is going to be, okay? Before you've even planted the crop, before you've bought a lot of inputs, you're going to know kind of where you're sitting. What's my bar, okay? The thing that is unique to margin protection that you have to kind of take into consideration also is it takes into consideration your inputs. No, your multi-peril policy does not do that. It's just margin protection is the only one that takes into consideration P&K, diesel, interest rates, fixed costs, that kind of thing. So very unique to this particular product. Again, I really emphasize it. I've said it probably 100 times already because we want to make sure you understand if you do decide to buy into a plan of insurance of this nature, that it is area-based. It's based off what your county does, okay? Not specifically your individual farm, okay? Obviously, your individual farm goes into those particular numbers, but they take the county averages when that's all determined, so. Limitations. Again, transparency is the key in going into something like this because the premium does have, it's not a cheap plan of insurance because you have the potential to buy up really high on your coverage, but you have to know that there's no replant coverage. Again, this is area-based coverage, so there's no replant coverage on your farm. If you have to replant, obviously your multi-peril policy, due to the 2020 rule, if you fall into that, you can get a replant payment, but also there's no prevent plant coverage with it also, okay? Again, the indemnities, it's from start to finish, we figure it's about a 21-month time set, okay? So going into it, you have to know that potentially you're gonna go through the season and you're gonna wait for about the half year into the next season to know if you're gonna get a payment, okay? Again, I had mentioned you cannot carry a margin protection plan along with your SCO and ECO. One key thing to know too is if the county has a loss, your farm might not have a loss, okay? So go into this thinking it's really two different plans of insurance when you think of it, okay? Because you might have bumper crops on your farm, but the rest of the county might not have got a lick of rain, okay? Well, the county might have a loss and you might collect on your margin protection plan, but you might not collect on your multi-peril plan, okay? You can have, like I said, the combo where you could collect on both, but because RMA will not allow you to double dip, that one will subtract from the other, okay? I think we're good on that one. One thing to just take away from this also is if you do buy like crop hail insurance, because it's not subsidized, those are all private products. So really you can carry as much hail as you want or any additional replant, things like that. Don't really affect that. For our BFRs, this is always, you're getting an additional discount with it too. So something to look at. If you can get just for being a beginning farmer rancher, there's an additional discount for that. You still have to be in compliance with FSA. So you have to have an AD 1026 on file. So it's not something that gets you around that, I guess. You can't have any written agreements. Again, claims are automatically triggered. So that's kind of a neat deal on that, that you don't really have to do any particular, keeping track of the inputs and stuff like that yourself. It's all done by RMA. And one thing that, and this will lead kind of into Blake's deal here, but does it follow the county averages? And I think that might be a good opportunity for us to kind of hand it off. And we've got a tool that's pretty that is very exclusive to Ag Country that can more or less give you a pretty good idea. Does this make sense to have a margin protection plan? Does ECO work? Does SCO work? That kind of thing that Blake's going to talk about that can help us make some decisions when it comes to that kind of thing.
Well, thank you, Joel. So that's what I'm going to lead into is talking about Optimum. It is a data-driven analysis tool that allows us to check your personal farm yields and what you do on your farm to the county averages. We can only see it if you are a customer of Ag Country. We can't just pull anybody's data in and look at it. So you would have to be somebody that's already actively working with us to see this. And what this does is it pulls your data in and runs about 100,000 simulations every day across all the different policy options that are out there. And I think there's like 2,800 options you can get into between yield protection, revenue protection, ECO, SCO, margin protection, and then the varies in between. So there's a lot of things it looks at, analyzes, and it tries to select the best one for your operation and your farm. See what works the best. So beginning of it, we're looking at this is a sample farm that we pulled off of their charts. We're not showing anybody's actual data. This would be non-irrigated corn from Hubbard County, Minnesota. So dryland corn out there on the sand. It's a little tough going, but this one, 318 acres, running the trend adjustment option. So we'll take a look on the next slide here. So the first thing is to look at is bring in the projected price. This had 508. That updates every day with the sales close. So this was probably a day ago then where it pulled that number in. So it's pretty close. The average yield before they do the trend is 113 with the trend up to 135. The margin price matched the projected price. So that's a good thing right now. Suggested options it shows on there is yield exclusion and the trend adjustment. So they had the trend picked right. So the yield exclusion being on there probably suggests that there was something that happened historically that you'd want to get off there so it's not on your APH. And then it does show the margin expected cost, what it thinks your margin is going to be, and some of the sales closing dates. So it shows a little extra information in there while you're going through it. So this being a sample farm, it does track the county pretty much exactly. Your farm likely will not be that tight to the county. It's going to have some variability in there. So the reason it wants the yield exclusion on there is obviously 2021. We all have a pretty good idea what happened in 2021 where it didn't rain at all. And they wound up with, 30 bushel corn, and the county was at 20. So dryland corn out there was not the thing to have that year. It was a pretty tough year. But they were up towards, 150 almost. So they've had some, this would have had pretty good years out there too. So there is a reason to have it. So go to the next one there. So this one's just showing the yields over history. I think it goes back to 1995 or 6 on there. And as you can see, the dotted line going up is the RMA trend, which it's only looking at dryland corn for that county. And the trend going up like that is kind of a testament to the hybrids that we've got, the improvements we've had in genetics in corn over the years. But it still doesn't stop there from being losses out there. There's good years and there's bad years. And when it doesn't rain out there, it's bad. The red flat line across is your 95% area plan trigger. So it's showing there's quite a few years where that 95 trigger would have gotten you a payment, or you could have had some assistance by having that area plan of coverage. Go to the next one there. This one is showing the same thing, your personal yield versus the county. The blue line is the 70% yield from like or 70% protection from the RP plan. And that really wouldn't have triggered any losses. It's only 2021 it would have paid out or gotten indemnity on that one. But if you look at the 95, the green line towards the top, that does show that there's 4 out of 5 years you could have potentially had an indemnity on your farm that would have helped you out in those tougher years.
Yep.
So going back to what Joel was talking about, that margin can really help you out. If you got even just a slight down year in the county, your farm can get some help from a margin or an area plan. This one here is just kind of showing past claims. It has history with margin protection going back to 2008 as far back as they've gone. And the revenue protection side, it's showing a lot of those rougher years where it's pretty down in that county. But the margin years are paying out, the area plans are paying out quite a bit more. They stacked coverage on top, and there is some difference between the blue bar is your revenue protection with margin protection. The purple is just the revenue protection itself. There is a little higher payout with the margin protection with revenue, and it does cost you a little bit less on the years where you aren't collecting an indemnity, and that's due to a premium credit that you get for having the plans stacked together. So over time, these can work for you to help, mitigate risk and help on down years, especially like 2021. I was looking at like close to $600 an acre payment, which would really help out with a lot of people. If you're really short that year, it could have really made a big difference and really helped out. So some of the other things that Optimum is looking at, like I said, this is an exclusive tool just for ag country. But we can look at ECO, SCO, and pasture range forage, and that one I personally have a little history with. You can go back to, I believe, 1948 to look at historical rains and see what's happened in your area, and it's a really good tool. Has helped out a lot.
The PRF, just to kind of chime in real quick, with the drought that we've been kind of experiencing the last couple of years, personally, we've had a lot of success with that particular plan. You've seen guys that usually take forage production plans have kind of made a little bit of a switch to the PRF just because it's so easy to outperform yourself on the production forage piece of it. This is a different way to kind of take a look at it and maybe use your premium dollars a little smarter for guys that do forage. So, good point, Blake.
Yeah, so that's where we're at there. So back to Jacob.
Well, yeah, if any of you guys have any questions about any of these programs or anything else that we offer, please contact any of us employees at any of our offices. But yeah, I will open it up for any questions. I guess I got a question for Blake right away.
Okay.
What's the biggest aha moment when people view Optimum for the first time, or while you're going through that? What do they see?
I think a lot of them, when you show them Optimum, when you can show where they sit versus the county, some guys think they really outperform the county and how they can either track it or how inverse they are to what the county's actually doing. So it's a really good way to show them, how these tools can help them view what they're doing on their farm and where a margin or an area plan can come in to help them.
Spot on.
And that probably helps them, make their decisions on
their
which
decision making.
coverages.
So you're making more informed decisions and you're better about, more secure in the decisions you do make.
Yep.
Okay.
And then I guess with Joel, if there is a indemnity with margin protection, is there an adjuster involved, or do they have to do like a farm visit at all? Or
Great question, Jacob. Honestly, no adjusters needed. We're seeing a lot of deferrals on soybeans, corn kind of being done right now. When you select an area plan like margin protection, there's no adjusters needed. Again, RMA tracks all of the information for you, so there's really nothing to kind of have to worry about with that piece of it. Good question, though.
Okay.
Yep.
Any questions from the audience out here? All right. Well, I think we can probably wrap it up then, and thanks everyone for coming. And hopefully we can enjoy the rest of the day and it stops raining. So, but yeah, thanks again for showing up and coming. And if you guys have any questions, reach out to any one of us after the presentation. So,
Thank you, guys. Appreciate it.